Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 25th year in business and soon to be our 26th. It's midday Thursday, December 11th, and the title of this week's audio blog is 6 Days and Counting, which I'll get to in a second. Now, the $64,000 question, or should I say, the hyperinflated zillion-dollar question, is how long can the U.S. government-led powers that be dodge the unstoppable tsunami of reality I wrote about earlier this week? I mean, how much longer can a house of cards stand when with each passing day is under siege from more powerful, concentrated, and malignant forces of wind, fire, and rain? And of course, when I refer to the house of cards, it is not the dollar I am specifically referring to, but instead the entire fiat currency-based monetary system, which, with each passing day, edges closer to the abyss. The best analogy I can think of is the great dominoes scene in V for Vendetta, when Stephen Ree's character speaks of the gradual building of events toward an inevitable boiling point. The end result was cast in stone when government corruption created an unstable, unsustainable society needing only a spark, any spark, to catalyze its unraveling. This is exactly the situation the world's dying monetary system faces, with its exponentially multiplying debts, historic wealth inequality, spreading inflationary pressures, banking corruption, and expanding government interference. Global economies are crumbling. International trade is not only contracting, but becoming more and more protectionist. And most important of all, billions of people are angry. In recent weeks, my audio blogs have focused on several of these big picture issues, whose cumulative force are building to a crescendo. First, there was November 13th's Revenge of the People, which discussed the proliferating votes of no confidence in global governments. From Catalonia, Spain, which decidedly voted to secede from Spain, to Scotland, which nearly voted to secede from the UK, and last but not least, Switzerland, which, if not for an historic propaganda and market manipulation scheme, would likely have voted to relink its once ironclad but now rapidly dying currency with real money. Next week's snap elections in Japan and Greece are of no less purport. As social unrest has grown so great, the leaders of these nations realize they must allow the people to speak, lest they be overrun legally or have whatever shred of credibility they still hold destroyed. And trust me, I'll have more to say about these in a moment, given their potentially historic ramifications. On November 20th, my audio blog Cartel Desperation Exposed focused on the aforementioned efforts, illegal, immoral, and unethical, to prevent the Swiss referendum from passing. Thomas Jordan, the Lady Macbeth of the central banking cabal, who doth protest too much to gold's usage, is probably patting himself on the back as we speak, knowing he won the day by utilizing every ounce of overwhelming power available to him, no doubt in concert with the Federal Reserve, Bank of England, and other one-percenters incentivized to hyperinflate away the standard of living of the other 99%. However, now that the evil deed is done, the S&B is faced with the prospect of defending an unsustainable peg with the dying euro, which in just 3 years has ballooned its balance sheet to an incredible 80% of Swiss GDP, compared to just 20% for the ECB, 25% for the Fed, and even 50% for the Bank of Japan. Not only that, the promised Swiss competitiveness never materialized, as the Swiss economy has increased by an average of just 0.4% per quarter since the peg was instituted 3 years ago. And worse yet, despite its CPI claiming deflation, Swiss inflation has been so pervasive, a referendum was voted on earlier this year regarding a proposal to increase the minimum wage to $25 an hour, or twice the level in most of the United States. This morning's failed ECB TLTRO free money lending scheme will only accelerate expectations of expanded ECB outright QE, which in turn will put further pressure on the euro franc peg, causing Monsieur Jordan to print still more francs. Ultimately, Jordan not only gambled his career on this peg, but Switzerland's historic financial independence. In time, perhaps much sooner than most can imagine, the peg will be overrun in the same unceremonious manner as the London gold pool in 1968. And when it is, and the entire world is clamoring for the tiny amount of actual gold that remains available for sale, the entire Swiss nation will realize they were duped by the Federal Reserve puppet Thomas Jordan, and the entire world will realize that Switzerland, though stronger financially than most, blew its one and only chance to regain the financial sovereignty it enjoyed for centuries. On November 26th, my front-running audio blog discussed how institutions and sovereign nations alike are rapidly realizing what's coming and consequently protecting themselves before the masses catch on. This is the essence of what I wrote back in May in the most damning proof yet of QE failure, and subsequently, October's 2008 is back with one temporary exception. In the former, I discussed how sovereign bond yields would plunge, with the exception, of course, of weak links like Greece, given the imminence of their defaults, in expectation of QE to infinity schemes by the world's leading central banks. Such an outcome flies in the face of the Fed's tapering scam, as given the so-called recovery they purport, plunging market rates clearly calls them out as the liars and frauds they are, as well as their data, per the article I wrote this week called All Economic Data Are Lies, which is why the FOMC meeting just 6 days from now has such enormous perception-altering perception, with expectations of removing the considerable time language from its policy statement, whilst rates plunge toward the year's lowest levels. Regarding the latter, the one temporary exception that differentiates the current environment from the all-out chaos that was 2008 is the Federal Reserve-led effort to support stock markets with a combination of overt and covert actions. Indisputably, the economy of essentially all nations are weaker than in 2008, whilst debt loads, individual, corporate, municipal, sovereign, and central bank alike, are orders of magnitude higher. The aforementioned social unrest is also reaching a fever pitch, and not only do central banks lack the dry powder to institute new major money printing programs, but the politicians would never be able to convince the people to trust their judgment. Throw in the vicious final currency war that has enveloped the planet since the Fed started its maniacal reflation scheme in 2008, and what we have is a dangerously overleveraged, heavily overvalued, politically and socially unstable world featuring record indebtedness, wealth inequality, and an all-time high cost of living, combined with plunging economic activity and commodity prices and an historic capacity surplus created by 2 decades of central bank catalyzed malinvestment. How long can the game be prolonged by simply propping up the Dow Jones Propaganda Average and other major Western stock markets? One never knows, but given the aforementioned headwinds, it's difficult to believe much time remains. And finally, last week's audio blog was titled Crashing Oil and Currencies, America's Death Knell. Obviously, the title is self-explanatory, and God knows I've written of these topics ad nauseum, in the latter case for nearly 2 years. In September 9th's single most precious metals bullish factor imaginable, for example, I have heard that the severe currency volatility inherent in the final stages of this, history's largest fiat Ponzi scheme, would cause any remaining economic impetus to implode. And since then, currency after currency have taken turns collapsing, led by commodity currencies like the ruble, rand, rupiah, bolivar, and naira, as the commodity index has plunged by an astounding 15%, but in essence, essentially all currencies without reserve status have suffered significant losses, which is to say, all of them. And thus, for those claiming precious metals to be in a, quote, bear market, we invite you to view gold prices in currencies other than the dollar, such as Japan, where yen-priced gold is just 5% from its all-time high. And India, for that matter, where rupee-priced gold is just 20% from its all-time high. To that end, the biggest pink elephant in the global financial world, by far, is the fact that not only did gold and silver experience record demand in 2014, whilst paper prices were attacked viciously, actually in 2013, but as such rates expanded this year in 2014, physical demand increased further. In the gold realm, such demand is far more difficult to quantify given the dramatically expanded Indian black market and recent Chinese procedural changes that allow gold to be imported without the reporting requirements of Hong Kong. However, given the extreme increase in Swiss refining demand, dramatic declines in known physical inventories, and the most negative forward rates in 15 years, it's not difficult to guesstimate that physical demand levels are roughly in line with last year's record levels. As for silver, demand is far more transparent, and given record demand for U.S. silver eagles and Canadian silver maples, as well as imports into the world's largest silver consumer, India, even the most anti-precious metal apologist would have difficulty claiming demand is not at a record level as we speak. Back to crashing oil prices, WTI crude sits near a 5-year low of $60.90 per barrel as I write, making the vast majority of non-OPEC production unprofitable, despite a dramatic global oversupply that Saudi Arabia, the world's low-cost producer, intends to maintain until the heavily over-leveraged, rapidly depleting U.S. shale oil industry, replete with its $500 billion of high-yield debt financing and leveraged loans, is permanently destroyed. This price war will be dramatically uglier than that of the 1980s, given that the entire world is amidst a central bank-induced debt coma, which will cause economic activity to contract further and further until inevitably all that debt defaults, either actively or more likely via hyperinflation. I spent 10 years as a Wall Street energy analyst, and thus was prescient enough to write unending energy independence hype about the shale oil industry nearly 2 years ago. After all, I had been covering fracking and horizontal drilling companies since 1995, like BJ Services, Baker Hughes, and Carbo Ceramics, and thus was well aware that nothing dramatic had suddenly come along. However, even I was shocked to realize how much debt was behind the so-called shale revolution. In essence, as damning a statement as imaginable about the aforementioned malinvestments caused by year upon years of zero interest rate policy, quantitative easing, and covert stock and bond market support. Thus, I cannot be more passionate about what I wrote in Crashing Oil Prices Portend Unspeakable Horrors, penned 2 months ago when oil prices were still $81 a barrel. Heck, since then, as prices plunged an additional 25%, I learned that a full 1/3 of all S&P 500 capital expenditures are attributed to the energy sector, which, I might add, were already in secular decline before the fall's historic price plunge, given the overwhelming evidence that, quote, peak cheap oil has long passed. Consequently, the upcoming collapse in oil field employment and financing will likely be historic, as depicted in my December 1st article, Shale Oil 2015 equals Subprime Mortgages 2008. There are so many topics to address in today's extremely important audio blog, but undeniably the overarching theme is the, quote, deflation fears catalyzing increasingly aggressive central bank actions on a daily basis. Heck, in the past 2 months alone, we've seen the ECB renew its QE efforts, despite relentless bureaucratic pressures, followed by the expansion of Japanese Abenomics, multiple unexpected Chinese rate cuts, as well as the PBOC allowing the yuan to weaken, and of course, the Fed leaking hints of expanding QE when stocks had an ever-so-brief episode in mid-October. Just this morning, we saw Norway cut rates to guard against deflationary pressures, whilst Russia raised rates, aiming, thus far unsuccessfully, to prevent the ruble from completely collapsing. In the aftermath of said final currency war salvos, the yen is plummeting, while the rupee and real are heading toward all-time lows, as are the Mexican peso, South African rupee, Indonesian rupiah, and countless others. This is exactly what I noted in the most bullish precious metal factor imaginable, which I assure you will only worsen dramatically as history's largest Ponzi scheme implodes. And I haven't even discussed the far larger, more ominous issue of imminent debt defaults, starting with Greece, which today is in dramatically worse political, economic, and social shape than at the heyday of its 2010-12 crisis, when Mario Draghi threatened to do whatever it takes to save the euro. To that end, I'm sure most listeners realize that by all objective measures, Greece has sunk far deeper into the abyss since it was saved 2 years ago. So much so that its banker puppet president was forced to call for snap elections this coming Wednesday, in which the anti-austerity Syriza party is expected to win. And by anti-austerity, I really mean pro-default and anti-euro, as no doubt a Syriza victory will dramatically increase the likelihood of Greece defaulting on its 400 billion euros of debt, much of it only made possible by Goldman Sachs created derivatives that enabled it to be hidden off balance sheet for nearly a decade. If this occurs, along with the so-called Grexit from the euro currency, the pigs crisis will reinflame like never before, at which point no market manipulation will be able to hide the fact that French banks own the largest amount of pigs bank debt, whilst German banks own the largest amount of French bank debt, etc., etc. Upon an already ugly warring bureaucratic structure, it wouldn't take much to overwhelm Draghi's whatever-it-takes goals, plunging Europe back into the throes of crisis. At this point, the mandated informality of Catalonia's secession referendum would likely be challenged vehemently, increasing the likelihood of Spain being torn apart internally, and so on and so on. And oh boy, what will the Swiss National Bank's balance sheet look like at that point, as it desperately tries to maintain its peg to the collapsing euro, whilst gold explodes higher. By the way, the Greek stock market is down an incredible 20% in the past 3 days alone on this expectation, including 7% today, whilst the benchmark 10-year Greek bond yield has surged from 7.2% to 9.2%. Not quite the 36% highs of early 2012, when Greece's economic and debt situations were significantly better than today. However, let's just see what happens after Syriza takes control in the coming weeks of not only Greek but other pigs' bonds as well. For that matter, Shinzo Abe himself has been forced to call for Japanese snap elections this weekend, just 2 years after taking office and initiating the suicidal Abenomics money printing scheme that has yielded the highest Japanese CPI reading in 5 years, its deepest recession in decades, a nearly 50% collapse in the yen, prompting China and others to expand the final currency war, 16 straight months of falling real wages, Japan's highest misery index, which adds up inflation and employment, in 33 years, a record rapidly expanding trade deficit, record low prime ministerial approval ratings, and the mockery of the entire world. Not to mention expanding deflation exportation to the West, which, as we know too well, central banks like the Fed, ECB, and BOE will not allow. But don't worry, as the Nikkei average is hyperinflating, in large part due to the Bank of Japan's overt strategy of monetizing Japanese stocks. Anyhow, it's only been 6 weeks since Abenomics was expanded, as I predicted it would be in August's article titled Decision Time. And this weekend, the Japanese will vote on whether Shinzo Abe's Liberal Democratic Party should maintain its majority. And this just days after Fitch Ratings Service warned of an impending Japanese downgrade following Abe's economically suicidal decision to cancel the October 2015 sales tax increase that was supposed to pay for Abenomics. Amazingly, the Liberal Democrats are expected to win dramatically, despite not only the aforementioned laundry list from hell, but numerous political scandals sprinkled atop. Frankly, the land of the setting sun is long past the point of no return, which is why I continue to anticipate it being the first world nation to experience 21st century hyperinflation. However, if in fact the people are stupid enough to give a vote of confidence in Abenomics, which according to the media is the principal cause of the snap election, the aforementioned currency collapse contagion and resultant expansion of global currency wars, particularly involving the Chinese, will likely expand dramatically. Back to today's audio blog title, it's not only just 6 days until the potentially historic Greek snap elections, but until the FOMC's final meeting of 2014. As noted above, the tapering scheme, or should I say scam, that started in May 2013 has been nothing more than an historic Federal Reserve-led effort to prop up favored markets like stocks, bonds, and real estate, whilst attacking unfavored ones like gold and silver with a vengeance. With each passing month, the money printing and market manipulation, both overt and covert, has expanded exponentially, leading up to today's terrifying scenario of a collapsing global economy and unprecedented currency volatility, wealth inequality, debt accumulation, and social angst. The Fed was able to maintain this delicate game through the so-called end of QE in late October, which I can only laugh about given that since then, the open market operations that were the hallmark of QE, conducted at 10 a.m. Eastern Standard Time each day, have never been more blatant or heavy-handed. To that end, we have literally experienced what I coined the dead ringer algorithm on the Dow Jones propaganda average every day since, no matter how bad the global news flow. Not to mention more intense precious metal attacks than anything we've seen in the entire 15 years since gold and silver prices bottomed. Anyhow, the next phase of this historically destructive, globally destabilizing scheme has been to get the considerable time language out of the FOMC's policy statements in describing how long it might be before they initially raise rates from the zero level they've been held at for the past 6 years. Unfortunately, the global economy is not cooperating with them. As per what I wrote in the most damning proof yet of QE failure, sovereign yields the world round, with the exception of basket cases like Greece, Russia, and Venezuela, are in free fall, including in the recovering states of America, where just this morning 30-year Treasury yields hit a new 52-week low. In fact, the benchmark 10-year rate would plunge as low as 2.14% this morning before magically rebounding in U.S. trading to the 2.2% level I've noted as the Fed's new line in the sand in my October 23rd article. 2.2% is the new 2.6%. And this with oil prices well below yesterday's closing prices, the aforementioned Greek crisis, and pesky resurgent gold and silver prices. To that end, I wasn't planning on writing an article today, as like last week, this week's audio blog has been significantly more comprehensive. However, after watching yesterday's comically blatant efforts to prevent stocks and bond yields from crashing, whilst capping maniacally gold and silver's attempted surge, I was inspired to write Desperation Tutorial yesterday afternoon. To that end, this morning's combined efforts of the PPT, Fed, Exchange Stabilization Fund, and cartel represent new lows for our financial central planners. And still, with just 6 days remaining, actually 5.5 now, until the aforementioned FOMC meeting, oil sits near its 5-year lows. Countless global currencies are in freefall mode. The 10-year yield sits at exactly the Fed's 2.2% line in the sand, not far from the year's lows. Gold and silver prices are surging, notwithstanding Fed manipulation efforts. Greece is in full-out crisis mode, and central bankers the world round are crying deflation. And thus, as the aforementioned 6 days counts down, the entire world waits to see if the U.S. powers that be can reverse the aforementioned rapidly expanding issues, let alone the Greek snap elections they have absolutely zero power over, to enable the FOMC to make the meaningless, but sure to be MSM hyped, decision to take considerable time out of the policy statement, and perhaps replace it with the word patient. If not, or God forbid such issues worsen, and the Fed is forced to turn tail and speak more dovishly, the global impact will be dramatic, starting with precious metals, which may well confirm the end of the 3-year cartel-manufactured bear market. If this occurred, there's no telling how dramatic the global chain reaction will be, from commodities to currencies, financial markets, gold and silver prices, and geopolitical shifts. Either way, the time is now, with gold and silver prices trading well below their cost of production, to prepare for an inevitability that just may become an imminence in the coming weeks and months. Have a great weekend, and if you do decide to protect your assets with precious metals, we hope you call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thank you.